Today we're going to talk about why is TLT prices dropping and 20-year bond rates going higher when the Fed says they're going to keep rates low for a long time regardless of what happens with inflation. Let's think this through. The number one influence on all interest rates is the Fed funds rate. The Fed funds rate, as I scroll down the list here, changes based upon what the Fed wants rates to do. The most important interest rate in the world is the Fed's fund rate, and that's the interest rate that banks pay for overnight Fed funds. And this overnight rate drives all interest rates from 30 days to 30 years. So this is how you steer the ship. You steer it with the overnight Fed funds rate. Now here's the rate that the Fed transacts with all the other banks. Each of the banks then transact with each other. So this is what drives the ship. As you can see in 19 it was 2.5. COVID hitting us in March, they dropped it to 1.25, and then they brought the offer all the way down to 1/4. So then the range was between 0 and 1/4. And if you look here, since March, the rate has stayed between 0 and 1/4. This is the overnight rate, but it drives all other rates. Okay, so everything else is affected by what happens with this rate, including the prime rate, including longer term rates, because it's basically the benchmark that everything else is pegged against. Now, the way the Fed uses the Fed rate is to steer the economy away from inflation and away from unemployment. Okay, so that's how they use this rate. So what has the Fed told us in the second half of 2020? What they told us back in September, they said we're not going to raise this rate even if inflation rises. So they're saying that they're willing to accept more inflation now, more than 2%. So they're not going to steer the ship to slow the economy if inflation picks up. So if the Fed is not going to protect us from inflation, what's going to happen with long-term rates? So let's go look at the yield curve and let's see what's happening with the yield curve today, a month ago, and let's go take a look at what the Fed did with rates back in 1981 to understand that when inflation gets out of control, what do they do with that Fed funds rate? So let's hop over and take a look at what a yield curve looks like. Now the Fed funds rate, the overnight rate, drives the entire yield curve. So what is a yield curve? On the x-axis, we have all the different maturities from 30 days to 30 years from left to right. On the y-axis, we have the interest rate that you're paid if you were to sell one of these bonds. So a 30-day fund is almost zero, about 1/4%. The 3-month rate is also about 1/4%. So you can see the short-term rates are close to zero. Now when we go out to 2 years, we can see the rates start to go up a little bit, and that's because of inflation expectations. So when people see inflation expectations moving higher down the road, then rates go up. The 5-year note is higher than the 2-year note. Then we have the 10-year note. That rate is even higher than the 5-year. Then when we go all the way 30 years out, the 30-year bond is trading even higher than the 10-year note. Now this is what a normal yield curve looks like, right? So rates go up as you go out in maturity. So what were rates like a month ago? So now we're going to use a colored compass to help differentiate the rates from a month ago. As you can see, the 30-day rate a month ago was the same as today, and so is the 3-month, and so is the 2-year. But as we start to go further out, a month ago, the rate was lower. And on the 10-year, the rate was lower even more. And on the 30-year, the rate was even lower than the 10-year a month earlier. So what's happening is rates are going up. Now, how do they use the Fed fund rates to control inflation? Well, in April of 1981, what was the overnight Fed funds rate? They increased it to almost 16%. Now, when rates get that high short term, it stifles the economy, slows things down, and then inflation starts to drop. And what we see is the interest rates start to go down as we go out in maturity. And that's called the inverted yield curve. So if the Fed says they're not going to raise short-term rates to stifle inflation, then long-term rates must go higher. So now when we look at TLT, now we know why prices are dropping and rates are going up. It's because the Fed is not going to defend against inflation.